screen with flashing red arrows, chaotic green charts, and complex technical jargon for one specific reason: to make you believe that growing your wealth is a dangerous game that only elite insiders can play. They want you intimidated, so you hand over your hard-earned capital for them to manage. Welcome to Day 5 of our strategic wealth sequence. Over the last 4 days, we stopped the bleeding. We secured your liquid defense fund and systematically dismantled the parasite of consumer debt. Today, the defensive campaign is officially over. We are taking the surplus you unlocked and crossing the threshold into active ownership. Today, we reveal exactly where to put your money in 2026. We will strip away the institutional gatekeeping and give you the clean, unvarnished blueprint to invest your first $1,000 safely, automatically, and permanently. Before we unlock the mechanics, subscribe and comment the word investor below. Let's change sides in the global economic game. When most beginners think about investing, they imagine a digital casino. They think of day traders staring at 6 monitors, buying a stock at 9 in the morning and selling it at 3 in the afternoon, driven by panic and adrenaline. This is not investing. This is a high-stress video game where 95% of players lose their capital within the first 12 months. Wall Street thrives on transaction volume. Every time you buy a speculative stock, a crypto token, or a trending option based on a social media tip, someone collects a fee. The system is designed to trigger your emotions: fear of missing out, greed, and panic, because emotional investors trade frequently, and frequent trading funds corporate skyscrapers. To build unshakable wealth, you must shift your perspective from speculation to ownership. When you buy a share of a company, you are not buying a lottery ticket. You are purchasing a legal piece of a real-world enterprise. You are buying a fraction of their factories, their patents, their brand equity, and their future cash flows. Imagine thousands of the most brilliant minds on Earth waking up every single morning with one objective: to make their companies more efficient, more innovative, and more profitable. When you are an asset owner, those minds are working for you. You don't need to build a multinational corporation. You simply need to purchase a piece of what is already built. The second major trap for beginners is stock picking. You try to guess which specific company will explode next. You put your first $1,000 into a single tech company or an electric vehicle startup because you read an article online. By doing this, you expose your entire financial survival to a single point of failure. If that specific company suffers a supply chain crisis, a CEO scandal, or a regulatory shift, your capital evaporates. Even the largest corporations can experience devastating collapses. Relying on stock picking means you must be right every single day. True wealth architects do not rely on luck. They rely on structural diversification. To eliminate individual company risk entirely, we use a tool invented by John Bogle, the founder of Vanguard, the index fund. Instead of buying a single stock, an index fund allows you to purchase a tiny fraction of hundreds of companies simultaneously with a single transaction. You are buying the entire basket instead of trying to find the single winning egg. The most famous index in human history is the S&P 500. It represents the 500 largest, most resilient publicly traded corporations in the United States. Names you interact with every single day: Apple, Microsoft, Amazon, Alphabet, and Visa. When you invest in an S&P 500 index fund, you instantly align your capital with the engine of Western capitalism. Here is the hidden magic of index investing. The index cleanses itself automatically. If a company inside the top 500 begins to fail, shrinks in value, and loses its competitive edge, the index automatically removes it and replaces it with a rising, highly profitable new enterprise. It is a self-healing portfolio that filters out losers over time. Over the last 100 years, through world wars, recessions, pandemics, and inflation crises, the S&P 500 has delivered an average annual return of approximately 10%. This means that despite short-term market drops, the long-term trajectory of human productivity has always moved upward. A 10% annual return means your money doubles approximately every 7 years. If you put $1,000 into this framework today and never add another dollar, compound interest will silently expand that capital without you ever lifting a finger. But our objective is not to stop at a single deposit. Our objective is to build a systematic wealth machine. Before we deploy your capital, you must understand who your enemy is. Traditional financial advisors will try to sell you mutual funds or actively managed funds. They claim that their team of professional analysts can beat the market average by picking better stocks for you. This is almost always a statistical lie. S&P Global publishes a famous report called SPIVA, which tracks active fund performance. The data shows that over a 15-year period, more than 90% of professional fund managers fail to beat the simple, low-cost S&P 500 index. The highly paid experts, with their supercomputers and Ivy League degrees, lose to a simple basket of stocks. Why do professionals lose? Because of fees. An active fund often charges a 1 or 2% management fee every single year, regardless of whether they make you money or lose it. A 2% fee sounds small, but over 30 years of investing, that single fee will consume up to 40% of your total potential retirement nest egg. Index funds, structured as ETFs or exchange-traded funds, have virtually eliminated this friction. Because they simply copy the index automatically through software, their management fees, known as the expense ratio, are often lower than 0.03%. You keep 99.9% of the wealth your money generates. The final piece of our introductory framework is the behavioral system called dollar cost averaging. Beginners always ask, is today the right day to invest? What if the market crashes tomorrow? Dollar cost averaging solves this fear by removing timing from the equation entirely. You invest a fixed amount of money at regular intervals, no matter what. When the market rises, your fixed investment buys fewer shares, protecting you from over-investing at the peak. When the market crashes, your fixed investment automatically buys more shares at a deep discount. You learn to view market drops not as a crisis, but as a massive retail sale on the world's greatest companies. To bridge the gap between your bank account and global enterprise, you need a specialized financial gateway, a brokerage account. In the past, opening one required high net worth status, piles of complex paperwork, and steep broker commissions. Today, the digital ecosystem has democratized access, placing the entry point directly into your pocket. Your first operational rule for 2026 is avoiding commission fees. Major digital brokerages in the US and UK now offer zero commission trading for index funds and ETFs. Platforms like Vanguard, Fidelity, Charles Schwab, or clean digital interfaces like Robinhood and Trading 212 have eliminated the entry toll. You pay nothing to execute your trades. However, a massive warning label must be placed on consumer trading apps. Many modern interfaces are psychologically engineered to mimic casino games. They use colorful animations, push notifications, and celebratory digital confetti when you buy a stock. This design is built to trigger compulsive trading, pulling you away from passive long-term ownership. A wealth architect treats a brokerage account like a high-security utility company, not a social media app. You want a clean, boring, institutional interface that encourages you to automate your investments and log out. The more exciting an investment platform feels, the more dangerous it is for your wealth longevity. Once your account is verified and your first $1,000 is cleared, you face the terminal. For a beginner, this screen can trigger instant decision paralysis. You are confronted with multiple options: market orders, limit orders, stop orders. To execute the dollar cost averaging strategy, you only need to master two basic concepts. A market order is your simplest execution weapon. It instructs the brokerage software to buy the chosen ETF immediately at the best available current market price. Within milliseconds, the transaction settles, and you instantly become a fractional owner of the underlying assets. It is built for speed and effortless automation. A limit order, on the other hand, gives you absolute control over price. You specify the exact maximum price you are willing to pay for a share. If the market dips to your target number, the order fills automatically. If it doesn't drop, the transaction stays pending. For a passive long-term index investor, a simple market order is usually all you need. In 2026, you no longer need enough cash to buy a full, expensive share of a massive company or index fund. If a single share of an S&P 500 ETF costs $500, you can buy exactly $50 worth of it. Modern brokerages allow you to purchase fractional shares, ensuring every single dollar of your capital is deployed immediately. Leaving your cash uninvested inside a traditional bank account or a brokerage clearing fund is a slow economic death. Inflation is constantly eroding your purchasing power behind the scenes. Money is not meant to sit idle, it is meant to act as capital, a kinetic force that must be constantly deployed into productive assets. To build a basic investment framework for your first $1,000, you must divide the market into three core asset classes: large cap U.S. equities, developed international equities, and fixed income core bonds. This macro division creates an unshakable structural shield across your global net worth. The first category is the foundation of your portfolio: large cap U.S. equities, typically anchored by the S&P 500. This asset class represents pure corporate innovation and dominant global market share. It drives your capital growth over time, absorbing the compounding power of the world's most dominant tech and consumer brands. The second category is developed international equities. This asset class captures the economic value produced outside the United States. Dominant giants based in Europe, Asia, and the United Kingdom, such as Nestlé, ASML, or Toyota. This ensures that if the U.S. economy faces a localized cyclical downturn, your portfolio has global engines running. The third category is fixed income, represented by high-grade government or corporate bonds. Bonds do not offer the explosive growth of stocks, but they act as your portfolio's shock absorber. During stock market panics, bonds provide stable interest payments and preserve your core capital when everything else is fluctuating. For a beginner, a classic, resilient allocation split for your first $1,000 is 80% global equities and 20% fixed income bonds. This ratio maximizes your long-term compounding velocity while providing just enough structural ballast to prevent emotional panic when the market experiences its natural cycles. The absolute biggest barrier to entering the market is the desire to time the entry perfectly. Beginners wait for months, saying they will invest as soon as the market drops. But while they wait for a crash that may not come for years, they miss out on months of compounding dividends and rising prices. The cost of waiting is almost always higher than the cost of a temporary drop. The secret to matching the elite wealth builders is eliminating yourself from the operational sequence. You do not log in every month to manually execute your trades. You construct an automated structural pipeline between your paycheck clearing account and your chosen index fund portfolio. You configure your brokerage account to execute an automatic recurring investment. You program it to pull a fixed sum, whether it's $100 a week or $400 a month, the exact day after your primary income arrives. The capital is swept into your diversified allocation before your human brain can invent an excuse to spend it. Automation converts investing from an active emotional chore into a silent background utility process. It frees your cognitive bandwidth. You stop checking stock market news apps, you stop caring about inflation headlines, and you stop tracking daily index fluctuations. Your portfolio becomes an independent engine growing in the background. Once this automation engine is active, your entire psychological relationship with consumption transforms. You are no longer saving what is left after spending. You are spending what is left after your wealth machine has been automatically funded at the source. This is the structural secret of the wealthy class. Now that the infrastructure, the orders, and the automation protocols are established, we must move to the final tactical phase, breaking down the exact real-world ticker symbols of the elite low-cost ETFs you need to target. In the next block, we strip away the abstraction and look directly at the specific vehicles that will hold your capital. To move from theory to execution, you must learn to read the specific destination codes of the global financial matrix. These are known as ticker symbols, 3 or 4-letter abbreviations that identify precise ETFs on the stock exchange. We will now unlock the exact low-cost vehicles used by elite sovereign wealth funds to hold their capital. The first and most critical code in your wealth engine is VU, the Vanguard S&P 500 ETF. When you deploy your capital into VU, you are instantly buying a slice of the 500 largest American corporations. Its expense ratio is an ultra-low 0.03%. It is the cheapest, most efficient wealth compounding vehicle on earth. If your brokerage platform uses different institutional providers, the equivalents to VU or IVV, managed by BlackRock's iShares, or SPI, managed by State Street, they track the exact same 500 companies with nearly identical performance. The brand name matters far less than the core underlying index structure. To activate your international defensive shield, you introduce the second ticker symbol, VXUS, the Vanguard Total International Stock ETF. This single fund holds thousands of corporations located entirely outside the United States. By combining VU and VXUS, you ensure that your wealth is tied to the entire productive output of the civilized world. To complete your three-pillar architecture, you anchor the portfolio with BND, the Vanguard Total Bond Market ETF. This vehicle holds thousands of safe, interest-paying government and corporate bonds. BND does not chase stock market growth, it acts as your gravity stabilizer, paying regular monthly income and dampening volatility. Once your allocation is set, such as 80% across stock ETFs and 20% in bond ETFs, you must maintain the blueprint through a process called rebalancing. Over time, because stocks grow faster than bonds, your portfolio's internal weights will naturally distort. Left unchecked, your portfolio becomes riskier than you intended. Once a year, you look at your asset weights. If stocks have boomed, they might now represent 90% of your portfolio. To rebalance, you simply direct your new automated monthly deposits to buy more bond ETFs until the original 80-20 ratio is restored. This mathematically forces you to buy assets that are temporarily undervalued. As an asset owner, you receive a quarterly financial reward known as dividends. Companies like Apple or Coca-Cola share a portion of their profits directly with you. For a beginner with $1,000, these dividend checks will start small, perhaps just a few dollars at first. But you must never spend them. You must activate a setting inside your brokerage account called DRIP, Dividend Reinvestment Plan. This protocol automatically takes every single cent of dividend income you receive and instantly reinvests it to buy more fractional shares of the ETF that paid it. It turns your wealth machine into a perpetual motion engine. Reinvesting dividends creates an exponential compounding loop. More shares generate more dividends buy more shares. Over a 20-year horizon, this silent internal loop can account for up to 30% of the total final value of your investment portfolio. You are manufacturing new capital out of nothing. The technology to build this machine is cheap and accessible. The mathematics are proven. The only variable that can break this architecture is human psychology. The financial media matrix is engineered to induce panic, flashing red alerts whenever the global market experiences its natural, healthy contractions. Every few years, the stock market will drop by 10, 20, or 30%. This is called a bear market or a market correction. Beginners treat this as a signal to sell everything and run. Wealth architects look at a market crash and realize that the world's greatest businesses are suddenly on a massive 30% off clearance sale. When the market drops, you have not actually lost any money. The only thing that has changed is a temporary digital quote on a screen. You still own the exact same number of fractional shares in those 500 companies. You only lock in a real-world loss if you panic, hit the sell button, and voluntarily surrender your position. To survive the psychological war of investing, you must lengthen your time horizon. If you look at a stock chart over a single day, it looks like a chaotic, random noise machine. If you look at that same chart over 20 years, it looks like an unshakable staircase moving upward. Stop playing the micro game, align yourself with the macro century. Every week, a new economic expert will predict an imminent, catastrophic market collapse that will end Western civilization. These headlines are designed to harvest your clicks and attention. The companies inside your index fund are led by adaptable, profit-driven teams. When crises happen, businesses adjust, prices rise, and the index moves forward. True financial freedom is not about buying luxury products to impress strangers. Financial freedom is the quiet confidence of knowing that your economic engine is independent of any single job, boss, or political administration. It is the realization that your capital is out there in the world, actively compounding every second you sleep. Today, we stripped away the confusion. You now know how to select a zero-commission brokerage, deploy your first $1,000 into a resilient 3-pillar allocation using VXUS, and BND, and automate the pipeline using dollar-cost averaging. The framework is complete. The engine is primed. Your mission tonight is to choose your brokerage gateway, log into your clearing platform, and set up your foundational investment targets. Do not let the inertia of over-analysis freeze your execution. Wealth favors those who deploy structural systems, not those who wait for perfect conditions. You have spent your entire life as an economic consumer, paying interest, buying depreciating products, and trading your finite time for survival income. Today, you took your first definitive step as an economic owner. You have officially crossed the line. You are now on the winning side of global capitalism. But our architecture is not yet fully optimized. Tomorrow, in day 6, we leave simple diversification behind and enter the domain of the tax shield. We will break down the exact legal tax wrappers used in the US and UK to ensure that the government can never touch a single dollar of the compounding wealth your new machine creates.